That said, let's get started. So, welcome to the January 2026, first one of the 2026 Roundtable on YouTube Live. Happy to see everybody here. Um, One of the things that we've received some feedback from these live roundtables, and one thing that some folks have said is the people that are on your roundtable, are they just members of the community, or, and in fact, they all have some sort of association or affiliation with Counsel Mortgage. So there's a few of them that are on camera today. By no means is this everybody. We have a lot of bashful people, and we've got 20, 25 people in the company around the country. But not everybody likes to participate on these, and I get it because people don't want to necessarily be on camera or what have you, or have a footprint live out there in the world. But anyway, for those that are here, let's just kind of go around. John, you've been with me the longest. Why don't you go ahead and identify yourself and let folks know who you are, give a little bit about your background and how you came about Counsel Mortgage. Go ahead.
Yeah, okay. Actually, it shows up as Counsel Computer, but my name's John Nichols.
Yeah, because that's the Counsel Computer that you're at.
Right, right. I started with John back in 2012 and as a loan processor. And then I went on to get my MLO. I moved here from Vermont, where I practiced law. I had a law practice back there for 40 years. Majority of the work I did was in real estate, but I did other areas, probate, etc. And so it's going to be 30 below in Vermont Saturday, so I'm happy to be here in Arizona, needless to say. But I really enjoyed working with John and all the other loan officers that we have. It's been a great experience, keeps my mind fresh, and that's about it.
Thanks, John. Going over to the one that I've known the longest, Alan. And I've known Alan since Alan was a representative at Countrywide, for those that have been in the business for a while. And that's how we met. He came over to my office and started showing me their what was
their product was fast and easy.
Fast and easy. Yeah, yeah.
And
Fast
a lot
and
of
easily
loan
went out of
officers
business.
said it wasn't fast and it wasn't easy.
Right.
So I did
So
a
why don't
lot
you
of
give
back work on it.
Yeah, why don't you, Alan, identify yourself, give a little background.
Okay. My name's Alan Powell. I grew up here in Phoenix, moved to California for 20 years, and then came back in 2002. Was a loan originator in California for a few years, and then got into the account exec side of wholesale lending. And then, like I said, well, John said, I've known him for so many years now. And but then about 20 years ago, I split away from that and just decided to specialize in what's called private hard money lending. So I've been doing that for 20 years, working with clients who are doing typically buying rental properties and fix and flips and or refinancing existing hard money loans. And so that's what we I specialize in and try to bring all the business in for that type of niche product that I've gotten myself into over the last 20 years. So it's been a lot of fun. It's very interesting. I enjoy working with those types of clients a lot, and it's tends to be a little easier when you're dealing with this type of business because we're really just basing our deals on valuations of properties. So it's really just figuring out valuations of properties. So
That's great. That's great. Thanks, Alan. Next, let's go to Mike Green. Mike, you seem to be all warm and comfortable. Where in the world are you, sir?
I have my seasonal foliage on. This is a seasonal garb that I wear. I'm Mike Green. The little sticker there says MJG. That's a leftover from my real estate company that I had in Phoenix for just that 25 years. And just practiced there commercial real estate and specialized in gas stations, of all things. And I started financing or providing financing for gas stations I think, gee, 8 or 10 years before I met John. I was with another company, and I looked, and I think we started working together about 2012 or maybe 13, something like that. At any rate, I closed down my commercial real estate company in Phoenix about 3 years ago now. I married a gal from Indiana, and she thought it'd be a good idea if we lived together. So I'm back in Indiana, which way back when is where I happened to grow up and be from. And John relates to that. He's from Illinois. So he knows what winter in Indiana is like. And we're experiencing it. So I start this about Labor Day, and it lasts until about Easter. And then it comes off, and I go kind of face naked there for a few months until I start again. I guess for our purposes, all I practice here is commercial lending. I don't do residential mortgage origination. It's just commercial stuff. Gas stations, I have a lot of contacts there. I was in that business as a realtor for 25 years and in Phoenix, and covered the state. So I have a lot of contacts in the gas patch back in Arizona, not just in Phoenix, but all over the state. And communications with lenders for commercial lending, just about literally all over the country. Commercial lending is quite a bit different than residential. The variables are different. The underwriting is different. It's just different. And so I practice in that area. I will rapidly tell you, I know very, very little about residential lending. In fact, I refinanced my house once when I was back there, and I had to come to John to originate my loan for me. Hey, you did a fine job. Got me one of
That's
those.
good. I'm happy to hear that.
Got one of those 2.25% loans that was going around at the time.
Yeah, you don't want to keep those. You want to sell them, move to Indiana instead.
I was sorry. Yeah. And the people I sold my house to when I came back here didn't want to assume it. They put new financing.
Yeah, because it was a VA loan, right?
Or 6.5, 6 3/4.
Yeah,
anyway,
it was a VA loan, right, Mike?
And so I'm back here now and originate loans. We can originate them nationwide. I don't know about Alaska. I don't think we're approved in Greenland yet.
No, not yet.
I don't think that's a real hot market for us. Get it market. Okay.
There's a lot of land in Greenland.
a lot of land for development. A lot of opportunity up there.
Yeah, so
maybe I'll take my beard and go.
Yeah, right. Can't be that much.
Anyway, that's what I'm about, and talk to people all over the country about all kinds of things. We have lenders, kind of nationwide, but mostly, honestly, in the what you call the money setters. We don't have a lot in Des Moines or places like that, but New York, Chicago, a couple places in Florida, and of course Los Angeles.
Yeah, Phoenix, Los Angeles.
Some even in Phoenix and Arizona.
Yeah.
But we go where the money wants to go to the properties that we have, and because we can have properties and businesses all over the country, we try to match those up with lenders that have an appetite for the market that we're in, and that works pretty well. It's a little bit of labor, a lot of phone and emails going on back and forth, but it can be done.
That's good. Clay.
Okay, I'm Clay Selland from represented in Arizona through Counsel Mortgage. I have my own mortgage company in other Western states, but in order to serve clients in Arizona, you have to be there. So I've worked with John. It's been a while and enjoying every moment of it. Really, really good stuff. Good. These kind of things are also good exchange where we, to get together and talk different. Everybody has their own specialty and that sort of thing. I'm also a CPA, licensed CPA, but I don't do any of that stuff. That's just my background in current licensing. And I'm a CRMP, which is Certified Reverse Mortgage Professional. And so I'm focused pretty much on the reverse side. And obviously Arizona is a great market for that. And really trying to help people all over the West. So
it's been a pleasure working with you, Clay. Definitely.
We've been at this for a long time. And so
well, there's the collective knowledge, and there's a few people that aren't on the call. I mean, the collective knowledge in this group is is pretty impressive. I mean, we definitely have over 100 years of lending experience total.
Sure.
I mean, even
Well,
more so.
Yeah, wait a minute. You and I probably have half of that. So.
Well, shh.
Oh, okay. Sorry. I'm off
Well, I'm
script.
not that
Sorry.
old, man. I'm not that old.
I am. So anyhow. Okay.
Now, there's a couple other people on the call that you won't be able to see on YouTube, but I don't, because they don't have their cameras, but I don't think that their microphones are on. I don't know if either of them can talk. Say anything? Nope. Okay. So a couple of our LOs, Sherry Harrison and Nicole Cameron, I love working with them. Sherry's done a lot of reverse. Nicole's done a variety of things, including VA. They're great additions and down payment assistance. Very knowledgeable folks. We just are so lucky, and that's just the people that are here on the call. There are so many other people. That we have another person who may be stopping by the office a little bit later. He's out of Tucson. So anyway, it's really great. My background, just real quickly, I started the company in 2007. I practiced law before then and was a CPA. I saw mortgages as an area where maybe my skills could help folks, basically, because there's nobody with my background that I know of that's doing lending. And I kind of built this from the ground up. It was organic. It's all been referral. That's pretty much how I met all the people that are here on the call, and that's how we've grown. And we've been very fortunate, and we've helped a lot of people. The one overriding thing I tell people that when they want to come work for Counsel Mortgage is that you're in the business to help folks. I mean, people hear about the mortgage business and say, "Oh, you can make so much money, whatever." Look, if you're not helping people, none of that stuff will happen. And so the basic principle is you have to help people, because a lot of the mortgage things can be very confusing to people, very complicated. If you help them, you get them a great rate. You take care of them during the process, they'll remember you, and they'll naturally refer their friends and what have you. And that's how we grew the company. So anyway, that's just a little bit of background. Some of the folks that are on the call, so everybody can see that these are all Counsel Mortgage folks. The opinions, though, are theirs, not necessarily of Counsel Mortgage. That's the lawyer in me. But anyway, and with that, I want to get rolling. So anyway, thanks, folks. Always good to have you guys on the call. And let's get started here. So the first topic I wanted to talk about is the market update, is where we usually start. So let me pull that up. Okay, here we go. Oh, what happened to the... All right. So I will pull up the market update. Here we go. There it is. And let's share the screen. Okay. Can everybody see that?
Yes.
Good.
Okay. All right. So that is the Freddie Mac came out this morning. This is the Freddie Mac Primary Mortgage Market Survey. And what the mortgage market survey, they say that the rate as of January 22nd for a 30-year fixed mortgage is 6.09%. But what does that mean? And I've said this a little bit over the time. They said, how is the national average determined? They collect mortgage rate of all purchase applications based on their criteria, and a national average mortgage rate is calculated out of all the selected loan applications. So these rates could be people who paid points. It's not necessarily a 0-point rate. So I want to make sure people understand that. This is just an average of all the rates that they've collected. And a lot of people cite to this. So if you're listening to the news and they say, oh yeah, the rate's at 6.09%, people are like, oh, the rate's 6.09%. Well, a person could have a 650 credit score and they're not going to touch 6.09% without paying points. So this is an average of all the rates. People could have paid points, maybe not paid points, whatever, to get to 6.09%. Just want to make sure people understand.
Purchase transactions, which typically has a bonus associated with it.
That's right, because sometimes refinance rates and cash out refinance rates can be a little bit higher. Good point. Very good point, Clay. So anyway, so this is for the rates for the last year. And as you can see, we started off about a year ago, right close to 7%. And then just last week, we went to 6.06. And then we clicked up to 6.09. And so let's kind of take a look at that. Let's see if we can squeeze that a little bit.
And if they drew any hard money loan statistics, they would skew that number as well.
Oh yeah, no. This is Freddie Mac. These are Freddie Mac loans. These are
Right.
agency loans. But so this is, anybody can Google this. You can go to Freddie Mac mortgage rates, and just so you can see where rates are. But this goes back all the way to 1970, and it's just fun to take a look at this stuff. So in 1970, when they first started it, the rates were at 7.33. Now we're lower than that today, and they got up as high as 18.27% in September of 81. But then take a look at that. From September of 81, for the next 30 years, rates came down till July of 2021. Or 40 years, I'm sorry, for the next 40 years. So there was a 40-year time period where rates, maybe you'd have a little bit of a jump up here or there, but there was a trend downwards for 40 years. That's 2 generations. Then, after coming out of COVID with inflation, things popped up. We have not experienced this piece here for over 40 years. So the things that we're experiencing today with the higher rates are things we haven't seen in a long time, and certainly not in at least a couple generations. So I say that so people understand. Will rates come back down? I don't know. Will rates get back to 4 or 3? Who knows? Probably not. I don't know. But just to give you some background to see where rates have been and where we are today. A lot of people are hoping, including everybody in our business, hoping that rates get down to 3 or 2% because we were busier than ever. But will that ever happen again? Not sure. So it's interesting. And the other thing to take a look at, and we'll take a look at the 1 year here, is, let me stop that share, but let me come up with another screen here, which is the 10-year note. Because oftentimes I tell people about the 10-year bond and how it mimics mortgage rates. So let's see if I can share the screen here. Let's see here. Like to see if I can put these back to back. Maybe not. Okay, so let's go. Oh, here it is. Yeah, there it is right there. Share. Okay. Can you see both the mortgage and now the 10-year note? Can you see both? And the
Yep.
10-year note, this is MarketWatch's website. Anybody can go there. And today it's at 4.253 right now. It's up 0.8 basis points. But if you go for a 1 year term, you can see, and if we compare it to the mortgage rates, everybody see the comparison here?
Yeah.
So it started up here, the 10-year bond, then it came down pretty low in April of 2025, and there was kind of a dip here in April in 2025. And then it kind of came back up like this did, came back up, and then it came back down, and then we had this. But now, wow, look at this big jump. Let's take a look at that. What happened here? In the last month, you can see in January 14th, which was just last week, it just jumped. And this is back when people were saying, oh yeah, I'm hearing rates are in the 5s, right? And what kind of spurred this was when the administration came out and said, oh yeah, we're going to have the agencies, meaning Fannie and Freddie, spend $200 million, or was it $1 billion? $200 million, I think, to buy mortgage-backed securities. That they said we're going to instruct that. So everybody got excited, and the markets reacted a little bit, and the 10-year bond came down, which, by the way, caused this little bump here with the 30-year fixed rate. It came down as well. But then with Greenland and the threat of tariffs and taking it over, there was a little bit of fear. And what happens is people started selling out of U.S. treasuries, and the treasuries became devalued. Why? Because a lot of foreign countries, including the Danes, are starting to say that their pension funds, they actually came out and said their pension funds are going to sell U.S. securities. They don't want to be involved. So as a result, rates came up. So, and that happened with the mortgage rate. And then with some of in the last day or so, there's been some talk about, well, maybe the tariffs aren't so well. And Trump said he's not going to, he's not going to use force in Greenland. So rates kind of came down back a little bit. And so there's a little bit of that's been a little relaxation on the increase in those rates. But when the administration comes out and says, we're going to get a new Fed chairman, we're going to try to lower rates, the Fed chair is going to lower rates. That's fine. That's just another factor that goes into all of this. What the Fed does is just another factor in determining where rates and where mortgage rates are going to go. What really influences a lot of this is economic data, like inflation, like unemployment, imports, exports, all sorts of different things affect this and also affect the mortgage rate. So with that backdrop, even if the next Fed chair in May decides to lower the Fed funds rate, I don't know that that's necessarily going to have an effect on mortgage rates. We may be in this range, even though things are coming down, and there is definitely a movement within the government to continue to move down mortgage rates. We may be in this range for a little bit. Now, Mike, I know that you write on this. Mike writes a monthly column that we publish in social media and a lot of things on the economy. Anything you want to add to this, Mike, as far as where rates could be?
Well, I just before this call, I got off of a webinar call with Marcus Millichap, who had their annual forecast, and a fellow named Mark Zandi, if you know that name. He's the chief economist for Moody's for years. Gave his outlook for the economy and all the stuff that goes with it for the coming year. He talks about Fed funds and interest rates, and the 10-year averaging 4 to 4.5 for the year, with all the things that go into that. But I think one of the things that's happened here in the last few weeks that also relates to our market selling off a little bit. And we talk about selling off of the bond market, that's the price selling down. And when the price sells down, the interest rates go up. So the bond market has been selling off every time the Fed, since about December of 24, maybe September 24, as the Fed started reducing interest rates, every time the Fed dropped rates a quarter of a point, the bond market on the long end would go up. And that's the 10-year also starts about 5 to 7 years, reacting opposite to what the Fed was doing with short-term rates. And a lot of people haven't digested that yet. There's a thinking out there that the Fed's dropping interest rates, the cost of my commercial mortgage is going to go down. And it's actually just the opposite. So if we're going to get a couple more, and the market seems to think it's worth 2 to 3 more quarter point drops here this year coming up, as those quarter drops happen, you might expect that 10-year to go up. Maybe not exactly a quarter point, but it's not going to come down. And you get 2 or 3 of those together, and we'll be at more at 4.5, maybe 4 3/4 by the end of the year. So if you're doing a commercial loan and you have the opportunity to do a variable rate or a fixed rate, you may want to take that fixed rate today, because a variable rate by the end of the year may cost you a little bit more.
Point.
But one of the other things I was going to toss in there about why our bond market's selling off has to do with what the Japanese did. And
It's true. You're right.
And if you don't look at Japanese, they've got a new prime minister over there, and she's doing things with their bonds that is taking them out of the zero interest rate environment. And if you look at their 30-year bond that was down, I don't even know how low it was, a point, maybe 1.5 a month ago. Now it's trading up at over 4. And so when you look at the holders of Japanese paper, and they can't get any preferred yield over there that they had before with what they call a carry trade. They go over and borrow money in their market, bring it over, exchange it for dollars, and buy our market, and kind of arbitrage those interest rates. Well, they can't do that anymore. So those bonds that were bought on that basis are being sold. And of course, when you put more selling into the market, demand stays the same, the price comes down, and interest rates go up. So that's the thinking is for the Japanese reaction. That's pretty much done. There's not a lot of that left to do, but it did get us a little firming of interest rates, and it did in the last auction. The Fed had to step in and buy a few more bonds than it otherwise would have to do, because a lot of that's institution. But what it does is it shows up in our interest rates, and that's what's important.
Yeah. No, that's great. Thanks, Mike. And that gets to the next point I wanted to talk about, which is the trigger term of the year. This is an election year. The word that you're going to hear time and time again, affordability. Affordability. People, this is the term of the year. People are going to be talking about affordability. What does affordability mean? Does that mean what your payment is going to be, what the prices of homes are going to be? Homes continue to go inch up, the prices of homes. How are first-time home buyers going to be able to make payments? Because that's where you're really hearing a lot of it is first-time home buyers. And there may be first-time home buyers that are watching this channel. How can you get a mortgage? How can you make a payment and make a payment that's reasonable to what you may be paying in rent? Anybody want to comment on affordability? Because that is going to be the key term of the year.
One thing that I got out of this Marcus and Millichap call,
Yeah,
is the spread now about affordability. The median price house, what the mortgage costs for a median price house versus what is the median income coming into it that would apply to the buyer. And that spread is about $1,100 negative.
oh, wow, interesting.
So, and the relative points are they can afford about $1,000 and change payment, and it takes $3,000 and something. But you take those together, and there was about an $1,100 per month deficit. So we're either going to have to get the payments down, and whether Trump can orchestrate that or not, or it's orchestrated by the market in terms of a price reduction of houses, or we're going to have to get income of the home buyers higher. But they've got to crunch about an $1,100 deficit right now. Percentage terms, that means their income, if you hold the prices of the house the same, their income to qualify for the median price home has to go up almost 50%. Now, and that's a lot of affordability to make up. I don't know if you can do that by getting Fannie and Freddie to buy $200 billion worth of paper. I don't know that that's going to do it.
Well, this is the next segue to what happened this week. This was a Wall Street Journal article that came out on Tuesday about the executive order that the president signed, where he's going to try to ban institutional investors from buying single-family homes. I'm sure we all heard about this. So this is what that executive order does. It directs executive agencies to find ways to stop the federal government from backing loans and providing other financial incentives for institutional investor purchases of single-family homes that might otherwise have been bought by an individual homeowner. It also bans those agencies from unloading any federally owned homes to large institutional investors. So that's what the executive order says. It's an interesting concept. Maybe that will help first-time home buyers and other folks try to get homes. But the order, as the article points out, leaves a number of questions unanswered. It doesn't address immediate steps for implementation. Instead, Trump is asking the White House staff to put together a legislative recommendation to codify the ban through Congress. So they still haven't defined who a large institutional investor is and what a single-family home is, and he directed Treasury Secretary Scott Bessent to come up with those definitions in the next 30 days. So we'll be watching. So let's see if they do come up, maybe by the time of our next roundtable next month, maybe they will have definitions of those.
John, I have a question.
Yeah.
If they are able to close the gap on that, and in fact, codify all these uncertainties. Will the institutions most likely hold what they have, or will they start to sell into the market knowing they can't buy any more back?
These are great questions. And that's one of the issues is we don't know, since we don't know what the codification is yet, the investors don't know necessarily how to plan. And what I've heard just from listening to a lot of the financial things is they're not going to be forcing people from selling their portfolios. If you already have a portfolio, you have it. It's more prospective, trying to prevent those folks from actually trying to purchase more single family homes. So then, it could create more opportunities for other people. That's what I've heard. I think they'd have a tough time trying to get people to divest because that could crash the market, right? And you don't want to do that. So,
well, that would drive prices down.
Yeah, that's right. That's right. That's right. Quite a bit.
Yeah.
Yeah. So in addition to his pledge to ban large investors from home buying, this month he said the government-backed mortgage finance companies would buy 200 billion, it was billion, in mortgage bonds in an effort to lower mortgage rates. And he'd also issued a new plan for letting Americans tap their 401k retirement accounts for a down payment on a home without penalty. So these are proposals in the executive order that we're going to have to see how it shakes out as time progresses. But that executive order just came out on Tuesday, right before he went to Davos. So we're going to see. We're going to just have to wait and see what happens with that and see if how that goes in the next month or so. Because we are in election year, I think it's going to be interesting to see all the different proposals that come out because I think we can all agree that this president is populist and he really kind of tries to come up with policies that he thinks that the public likes to hear and wants. And so I think that so that's something that we're going to be watching. So this is going to be interesting to see how this all plays out this year. Any comments on that? Nope. Okay. Keep moving. All right. Next, I want to talk about some of the things that we see in our business. So a lot of times, and it's usually more of the first-time home buyers, they'll say, hey, this mortgage company came up to us, and you know what? They're promising me a free refi. So even though I'm going to do the purchase loan with them, they're promising me a free refi when rates come down. So I think I'm going to do my loan with them. And I'm scratching my head. I'm like, well, wouldn't you try to get the best loan for yourself right now? And why are you trying to promise on their trying to make a decision for financing based on a promise in the future where that lender may or may not still be in business when the refis come around, and who knows what the rates will be. So what I wanted to do was kind of educate some folks as to how can people kind of advertise, oh yeah, if I do a purchase loan with them, I'm going to get a free refi down the road. Well, they may just, when you do a loan, the lender gets paid a certain amount of money, and the higher the rate, they get paid a little bit more money. So they could do there's still closing costs no matter what loan you do. There's still an underwriter that's going to underwrite the loan. There's still, in most instances, an appraiser. There's a credit reporting company that's going to charge you a fee for that. There's a title company that has escrow and title insurance charges. Those costs exist in every single loan. It's just how do they get paid? Lenders can increase the rate to have the rebate from the loan pay those costs. It happens. And they do that. So even though they may be promising you a free refi, not sure that free refi will be at market rate. Why don't you just get the best rate you can get now, and then when refi comes around down there, we'll look around and try to get you the best rate and the best deal at that time. So when it's a sales technique, and there's a lot of sales techniques that are used in this business. Be careful when they say, I'm promising you something in the future. Why don't you just go ahead and accept my terms today? Why aren't you presenting me the best terms you have today, and let's just go with that? So anyway, that's something to keep in mind. Any comments, panel?
I've had a couple of those come up, and I say I can do the same thing. Because, and I explain what you just did, is that for a slightly higher rate, there's a credit that could be used to make a loan zero. So I can do the same thing, but I absolutely agree. Get the best deal we can work on now, and we'll let the chips fall where they may in the future. And we'll be in shop it then, and we'll see what we can do.
Yeah, agreed. Okay, that's great. Anything else on that topic? You know, it's funny, this business, and remember, I come from a lot of people in this business. This is it's a sales business. You know, a lot of people have a sales background. That's not my background. My background's the advice business. I was a lawyer for 10 years or whatever. I gave advice. I didn't sell. But so when I hear these things, I hear all these little sales techniques. And I'm like, this is just crazy. You know, here's some. So I think of it from the advice background, and so that's where I come from. So,
No.
Sherry, you may want to mute your microphone. We actually can hear you. So,
Oh, you can.
oh, hey, there you are. Do you want to say anything?
Hi, how are you?
It's good to hear from you. They won't be able to see you because they don't have the camera, but well, we gave introductions earlier. Do you want to give a little introduction to yourself about yourself?
Well, I'm from Chicago, just like you, and it's cold there. I feel sorry for Mike. I think his name is Mike.
Yeah, Mike. Yeah.
And I'm in Tucson. We do reverse mortgages and forward loans here, and you're a great company to work for.
Yeah, that's great. Well, thanks, Sherry. Appreciate you. And so I'm happy to hear that your microphone's working. So you can check. You won't be able. Those watching on YouTube, you can only see the folks whose cameras are on. But you know, when everybody's quiet and all of a sudden you hear something from above, that may be Sherry talking. So
Yeah, I didn't know I had a microphone on here. I bet
I
it
know
has,
this is good news.
Oh.
This is good news. I'm happy to
it's a
hear
new
that.
computer, so I have to figure out how it works.
Okay, great, super. All right, the next thing I want to talk about is condominiums, and how lending on condominiums could be there's a little bit more involved than on a single family residence. In a condominium, when you're buying a single family residence, you're going to get an appraisal. It's on a quarter acre or whatever the land is. There's a house there. The lender's going to be able to see everything. They're going to see the plat map. They're going to see the title. They're going to see the appraisal. They can lend on it. When it's a condo, it may just be one unit in a multi-unit development. So they don't know about the neighbors. They need to know about all the neighbors and everything that's going in that condominium association before they lend. So I always tell people there's a two-step approval process when you purchase a condo. It's your credit and income, and then the condominium needs to be approved too. So today, one of the things that needs to be reviewed by all lenders is a condo questionnaire. And a lot of you folks don't never even heard of a condo questionnaire before. So I am going to pull one up and we're going to go over it just so you can be familiar with what a condo questionnaire is and what to prepare yourself for if it comes up. So let me see if I can pull this up. Here it is. Okay. Does everybody see this? This is the Fannie Mae Form 1076 Condo Project Questionnaire. And I'm going to blow it up a little bit. So this is something that is completed by HOAs on every transaction with a loan. And HOAs usually charge a fee for this. So you, the public, are going to have to charge a fee, a few $100 to get this information. And so these are the types of things that they talk about, and are the things that lenders want to know. They want to know, does the project contain a hotel, motel, resorts, deed or resale restrictions? Because if it contains any of these things, it may not qualify for financing for Fannie or Freddie, like a regular 30-year fixed mortgage, which most people get. So it's important to know that. If it has some of these things and it doesn't qualify, you can still get a mortgage, because then it may not be a warrantable loan, is what they say in the industry. But those rates are not going to be Fannie Freddie rates. They're going to be a little bit higher. So it's important to know that there are conditions on condos, and I want to try to let you know what things you should be aware of. Is the project 100% complete, including all construction or renovation of units, common elements, and shared amenities for all project phases? And then there's some questions about the phasing, if there are phases. Is the project a conversion within the past 3 years of an existing structure that was used as an apartment, hotel, resort, retail, or professional business? These are things that lenders consider when they're trying to decide whether they're going to lend on a condo. How many unit owners are 60 or more days delinquent on common expense assessments? That right there during COVID was a reason why a lot of HOAs didn't qualify for condo financing. Because of COVID, they were delinquent by 60 or more days. Quite a few unit owners were. In the event a lender acquires a unit due to foreclosure or deed in lieu, is the mortgagee responsible for paying delinquent common expense assessments? Is the HOA involved in any litigation? So, because there could be exposure to the HOA that the lender may not want to lend in. And then regaining ownership of units. The percentage of owner occupancy, if you're buying a condo as an investment property, comes into play. It's got to be more than 50% owner occupied. And doesn't necessarily come into play if it's a primary residence, but it does come into play if it's an investment unit. Complete the following table if more than one unit is owned by the same or individual entity. If one entity owns at least 10% of the units of the condominium association, then Fannie and Freddie don't want to play. They're like, there's too much control in one person to make decisions for the whole board. We don't want to play in that area. Are any of the units being used for non-residential or commercial space? And then this particular one, and you can Google this as Form 1076 on Fannie Mae, it's out there. It goes further now. And the reason why there's an addendum that goes further is, remember 4 or 5 years ago, those condo collapses in Florida, and terrible, terrible tragedy. They just completely collapsed. Well, Fannie and Freddie want to know more about structural integrity. And that's where we get a lot of action and push and pull when we're getting these condo questionnaires completed. Here's what they ask. When was the last building inspection by a licensed architect, licensed engineer, or any other building inspector? Did the last inspection have any findings related to the safety, soundness, structural integrity, or habitability of the project's buildings? These are things that they're asking about now on condominium questionnaires. Is the HOA cooperative corporation aware of any deficiencies related to safety, soundness, structural integrity, or habitability of the project's buildings? So, and then it goes on. But the point of this, and really, is just to make you aware that if you're purchasing a condo, understand that there's more steps than just, oh yeah, I like that unit and I want to get a loan on it. It has to meet certain criteria as provided by Fannie or Freddie. So what I typically tell folks is, because you don't know unless you get this condo questionnaire filled out and you give it to the lender, and the lender runs it through their condo project manager, whatever their analysis is, to see if the condo is approved. So you won't know. And unless you're going to pay the few $100 to get the HOA questionnaire, which most people don't. So what I tell folks is, if they're working with a real estate agent, the real estate agent can look on the MLS and see for themselves how many units and what units in that condominium association have sold in the last 30, 60, 90 days, 180 days, and find out what type of financing was involved. If they look at that and they say, look, John, we reviewed it, and in the last 6 months, all transactions in there have been cash. Could be a red flag. That may be because they're having trouble getting financing in that unit. Or they can look at it and say, oh yeah, we've had conventional financing, fine. Or they may say we've had FHA or VA. That's a little bit different, because FHA and VA condo purchases have to be on the FHA and VA approved condo list. So if you're doing an FHA or VA loan, let us know. We can look up to see if they're on the approved condo list. So I just wanted to give folks a little background on condos and condo purchasing, and see if the panel has anything they want to share with condos, or maybe some experiences.
The lawsuit one I had personal, business experience with in depth. It hung up a loan for 7 or 8 months. And I was in California as a loan originator at the time, and the client was refinancing their condo, and rates were starting to decrease. I think we were at 8% or something at that time, and it was coming down to 7. And so there was kind of a more influx of more people refinancing. So when we did the condo cert, it came back with a lawsuit pending, and it was actually an injunction. And what it was these condos had been built recently, so they were still under warranty. So they were in clusters of 3 units together in these different clusters. And one of the units, or the three of the units, were having water seepage coming up from the pipes. So the construction company goes, okay, well, it's under warranty, but we got to move everybody out and dig into the cement slab and fix the pipes. Well, the middle unit was a woman who was terminal, and she wanted to pass away in her condo. So
Oh,
she
gee.
blocked the whole construction
Oh,
until she actually passed away.
oh my goodness.
And we had to wait until she did. And nobody and it was like a 200 unit complex, and nobody could get refinancing because of that.
Uh,
Yeah.
Now, with that point about litigation, though, just because there's litigation doesn't mean that you can't get Fannie or Freddie financing. Many times you can get an attorney letter as to what the scope is of the litigation, so then the lender can make a decision as far as,
Right. Yeah.
well, maybe the exposure is 30 grand and they have
Uh,
300,000 in reserves. We're not worried about it, or whatever it is. So
Yeah.
we've gotten past that on litigation matters.
Yeah.
So we've just been joined by Mr. Flint Crump. It's good to see you, Flint.
Hi.
One of the things we did today as the beginning is everybody got a chance to introduce themselves and explain how it is that they're associated with Counsel Mortgage, because I've had some feedback from some folks saying, who are those folks that are on there? Are they just people in the community, or are they somehow associated with Counsel? And everybody's had a chance to do that. Why don't you go ahead and introduce yourself and explain how you're associated with Counsel?
Okay, yeah, my name's Flint Crump, and I am a licensee mortgage loan originator under John's brokerage license. So I have been chasing mostly commercial foreclosures for the past several years. And
Commercial foreclosures. You can get a loan on a commercial foreclosure?
yes, you can. Yeah, we have several lenders that will look at the scenario and
They're
see
called
that
foreclosure bailout lenders, right?
for foreclosure bailout lenders, and if the scenario makes sense and it's not just mismanagement, then they'll look at the opportunity for a fresh start, but it's higher interest rates. So I mean, it's temporary. There's got to be something else change. Otherwise, you're going to be in it with probably higher interest than you already were, unless it was some other previous bridge loan. And yeah, my history prior to that is with commercial real estate and residential real estate since 2000 here in Arizona. So yeah.
That's great. Well, thanks, Flint. Appreciate that. Our next topic are the differences between a mortgage broker, a mortgage banker, and a banker. The public does not know that they're even different entities. They figure they just go to somebody who can get a mortgage and they just go for it. We are mortgage brokers. What does that mean? That means that when you get a loan through Counsel Mortgage, you're not going to be making payments to Counsel Mortgage. We're brokering the loan to another entity, whether it's an insurance company, a private money individual, a bank, a wholesale mortgage company like United Wholesale Mortgage, who is a popular one, or there's so many of them out there. But we broker the loan. So you don't make payments to Counsel Mortgage. And so you're like, well, why would we want to work with a broker instead of a bank? Well, because we get things offered to us wholesale. And so we often are very, very, very competitive as compared to other entities. And quite honestly, I want to be in the business, given my legal and accounting background, unless I had something that I felt was a very competitive business model. And that's what Counsel Mortgage is. We're mortgage brokers. And just from the panel, you can see here today, we can do a ton of different things, from the normal residential to commercial to reverse to hard money. There's so much we can do here. And the level of expertise we have is definitely, I'd like to compare it to many others out there. We would certainly hold our own. And so that's what we do. We are in the business of helping you. Mike has a nice saying. He says, we work for you, not the lender. And we've kind of coined that a little bit because that's exactly what we do. We work for you, the customer, not necessarily the lender. Where a bank, you go to a mortgage, if you just go to your regular bank where you do all your deposits or whatever, they only have their own products that they can offer you. And they offer them at the rates at that particular day. I will tell you that rates go in and out. I see get rate sheets from all these different entities. Some days they're really competitive. Some days they're not. Why do they change? Because of their inventory, their capacity. Maybe they don't have capacity to get a lot of low interest rate loans, or maybe they don't want to take those risks right now. But when you go to a bank, you just have that one offer. That's all they can offer you. And so one of the advantages of a broker is we just are trying to find, we're working for you, not the lender. We're trying to find the best deal for you. So, and the banks compensate us because we're helping them place their money. Now there's this hybrid called a mortgage banker, and they'll say, we can broker or we can bank. But in reality, mortgage bankers tend to bank more. And honestly, it's because the owners of the mortgage bank make more on those things as opposed to brokering. So you'll see mortgage bankers say, oh yeah, we could do both. But in most instances, they will bank more than they broker. And we can compete with them too. So the reason why we have a mortgage broker model is because we feel it's the most competitive model in this type of business, in the mortgage marketplace. And that's why we stayed broker. A lot of people in 2007 thought the broker model was going to go away. That's when I started the company. I'm one of these opposite guys. I felt like this is the best time to get in because the model is so good. It's wholesale. It's what people are going to want. And we've been fortunate enough to grow. Any comments from the panel on those differences?
Well, and it's just important to know that our clients, we get paid by the lender, not by our clients. So
in most instances, unless we work
Yeah.
something out. Yeah.
right.
Well,
Anybody else?
For commercial, that's not always the case.
That's right.
Some commercial lenders will want to pay us directly from themselves. Others will want us to be paid by the borrower.
Yep.
And that's dependent upon the lender.
Yep.
The net of it, from the borrower's standpoint, you can't cut the difference with a sharp knife.
Yeah.
And in my side with the hard money, a bank is just not going to work with, these private individual investors who are buying fix and flips and rental investment properties, non-owner and commercial as well. And it's just that they won't be able to help service those types of clients as well as I can, or Counsel Mortgage can.
That's right. No doubt about it. Now let's go into the next thing is a particular thing that appears in properties. And one of my realtor friends and I were talking about this last week, and I said, I'm going to bring it up on our YouTube, is polybutylene piping. Has anybody come across polybutylene piping? Do you even know what polybutylene piping is?
Yep.
So I'm going to pull up polybutylene piping.
So the condo, like in 2002 or 3, down in Chandler, I think the subdivision was called Lemon Tree, and there were clusters, attached condos, single story, and yeah, they were having pipes breaking because of the term of the age of the properties were like, I don't know, 20 years to 30 years already, something like that. And so that's so that's the replacement. That's the new stuff. Sorry.
So no, yeah. No, that's all
It's
right.
PVC piping that was
That came in. That's
because
right. But this is good though,
And
Flint.
so this is
So polybutylene piping, this is
replacement.
AI. This is Gemini AI. Polybutylene piping is a flexible gray plastic piping used in homes from the 70s to the mid 90s. Known for its low cost but prone to degradation and catastrophic failure due to chemical reactions with chlorine and water, leading to leaks, property damage, and difficult insurance coverage, making full replacement a common recommendation. there are lenders who will not lend on polybutylene piping. I've come across this because we had some clients that wanted to buy a house with polybutylene piping about a year ago, and we couldn't find it. Insurance companies have a tough time with insuring homes with polybutylene piping. So this is a specific area, but if you have a home that has polybutylene piping and the home was built from the 70s to the 90s, you may have a tough time trying to get a mortgage on it, a conventional mortgage. Now, hard money folks probably be the way to go until then you go in and you repair it, and then you could probably get a regular mortgage. But it's one of those things that could blow up a deal. You won't know about it, and then all of a sudden, appraiser goes in, makes a comment, which he doesn't have to, but he makes a comment on the notes. Oh yeah, house has polybutylene piping. Underwriter sees it, says, "Oh my goodness, that's going to affect the value of the home. This is not something we want to even deal with," and it could blow up the deal. So I wanted to make people aware of polybutylene piping. If the house you're looking to purchase has polybutylene piping, contact the lender and make sure it's still okay to get a loan on that property.
Flint, are you aware, was this piping ever used in manufactured housing as well?
Not sure, but I wouldn't be surprised. It was pretty prevalent during that time frame. But the instance I had about a year ago was actually a single family residence in North Scottsdale.
Yeah.
So, all right. The next topic I want to talk about is VA loans. And a lot of people feel like, okay, when I do a VA loan, all I can, I get my certificate of eligibility from the VA, and it tells me how much I can afford. But did you know if you are using some of your eligibility and you're currently living in a house, and then you're like, I want to go buy a new house, and you're going to rent my old house, you may still have some entitlement left to use your VA benefits to purchase the new home and still get 100% financing. This is the calculation on how that is made, so you know how it is. So let's say you have a VA loan, and assume that your certificate of eligibility shows an entitlement charge of $95,000. Can the veteran still use his benefits to purchase a home? Yes. How much entitlement remains? Well, the first thing you need to do is you need to calculate the county loan entitlement limit, which oftentimes matches the conforming loan limit. Right now, the conforming loan limit in Maricopa County is $832,750. And entitlement is a quarter of that amount, which is $208,187.50. So how do you calculate how much entitlement you have remaining? So you take the $208,187.50 minus the amount of entitlement that's shown on your certificate of eligibility. So you have $113,187.50 remaining. You multiply it by 4, and that's the loan amount that you can still get 100% financing for on a VA loan if you purchase another home. So just because you have used your benefits doesn't mean you can't use your benefits anymore. You still can. And I've done these loans. I think they have to go to the VA for approval, but it doesn't matter. It's just that you can still get the deal, and I've done them. I did one where both parties, they're a couple, they were both veterans. They just got together. So she bought her home with a VA loan. He bought his home with a VA loan. They married and they wanted to buy another home with a VA loan. So I had to do all the calculations for everybody. They had enough joint entitlement left so they could buy another home. And that was a fun calculation to do. But anyway, that was so you can have some you still can buy a home with a VA loan even if your entitlement is used up. Any issues or questions on VA loans and the use of entitlement? That's a thing that comes up here and then, and I wanted to go over. So the final item I have, and I know we're running a little long, we're getting to about an hour, and that's about usually how long these things take, is kind of gets to where we started the conversation with, which is where rates are, and the rates are in the 6s or whatever. And so what I'm trying to do is I'm trying to find those things to beat up the amortization table, because it's the amortization table that really is playing here as the amount of finance charges you pay over time. So, for example, let's say you are, and I'm going to use the Counsel Mortgage calculator, which is available in the Google Play Store. Thank you very much. if you are so interested. So let's say that I want a $500,000 loan and using 6% as an interest rate for a 30-year term. I calculate the payment, and the payment's almost $3,000 a month. But during that time, you're paying $579,000 worth of interest. Here's the interest, 6%, 579,193. So so that first payment is $498 only towards principal. The second payment, $500, the third payment, $503. You're mainly interest. So how do you beat up this amortization table? Well, one idea is there are interest-only loans. There are interest-only loans where you can pay a minimum of just the interest per month, but as you pay more principal, the principal balance comes down, and so the amount of interest you pay each month goes down and down and down. So, because it's a simple interest calculation, there are loans out there that will provide for interest-only loans, simple interest. There's also another loan out there that is not new. It's been around for a while, but we can broker it. And it is called, it's been called the all-in-one loan. It's been called the wealth builder loan. But let me pull up a little equity thing here. So let's change this to a $400,000 loan amount, just to match my example I'm going to give. So that shows $463,000 of interest. There's a loan product out there where it's a line of credit on your home. It's used as a checking account, so every deposit you make in there knocks the principal balance down. What? And then you can write checks, which will raise the principal balance up. You use it as a checking account, and over time, you can pay down your loan quicker, and the amount of interest you pay over time goes down. Here's the loan comparison provided by one of our lenders who we broker to. So everybody see this loan comparison?
Yep.
Okay. So in this instance, we're just talking about a refinance. It's an adjustable rate. It's at 7.5%. In this example, the estimated value of the home is $1 million. You can borrow up to 80% of the value. You can get up to $800,000. But let's say your current mortgage is about $400,000. So all you need is a $400,000 draw. So you're thinking about, well, maybe I'll do that, or maybe I'll just refinance into a 30-year fix at 6%. My monthly income is about $7,500 a month, which gets deposited in my account. If you do this new wealth builder loan, look at the amount of interest and how quickly you can pay, because you're putting $7,500 into your account every month as compared to a regular loan. Even though this rate is 1.5 points higher, it's the amortization schedule. It's the amount of money you're borrowing over time that matters, because that interest you're not going to get back. That interest, you can't deduct it on your tax return, but that's it. You're not going to get back. This $463,000 of interest, you will not get back. You just knocked it down by 3/4 to $100,000 by doing something like this. And so even though the rate's higher, don't get caught up in the rate. It's the ability to knock down the loan quicker over time. And this is where, as rates stay high, it's products like this that could make a difference. This product's been around for a while. Not everybody likes it. Other countries offer this. It's not as prevalent here in the US, but it's something I'm certainly considering for my home. But I want to make it aware to everybody out there that this is another way to knock down your interest over time and really make your payments go towards principal. And they kind of do it for you, because if you have direct deposit, it just automatically goes right to pay it down every single month. And so if you can issue checks off of it, and it'll go up. So obviously you need to have in order for it to go down, you need to have a positive cash flow, right? You need to have more deposits coming in than checks going out, so that but as that happens, your balance in that checking account continues to knock down the mortgage. It's pretty slick. Any comments on this?
So they give you a debit card to use what you need?
I
Checks
think they
and debits?
can. That's a great question, Flint, because I asked that exact same question to my account rep over there. Let me see what she said. I can get it. Oh, here it is. Yeah, I asked about, so they offer debit, checks, wire transfers, check requests, and bill pays. They currently do not have Zelle. I asked her if they had Zelle. They don't have Zelle. But yeah, they do have those options for pay. Pretty slick, huh? So I think as rates continue to stay high, we need to be creative and look at different ways to attack that issue straight up. You know, and this is a great way to do it, attacking the amortization table, because it's the amortization table that, boy, that's just a, you know, you look at how much you're paying in interest. So, you know, we're going to get, if rates come down, people are saying, oh, I want to refi to 5.5, or I want to refi to 5%. Okay, great. You're starting the amortization table all over again. It's a renter's thought process, because it's like, oh, my rent went down, but it's not rent. I mean, you're paying interest, you're starting your amortization table all over again. Some of my clients will say, you know, John, I was in a 30, I want to do a 25 or a 20. And we have some lenders that'll do like 23 or 22. You can pick your term. And we could do that too. And then that makes sense. But yeah, it's not a cash, it doesn't necessarily have to be a cash flow. But that also goes to a lot of what's your point of doing the financing transaction? That's something I talk to all our clients about is, are you in this for cash flow? Are you in this because of how it fits in your bigger investment scenario? Is it because you don't want to liquidate funds you have in a retirement account? So if you're borrowing money at 6% and you're making 10%, you'd rather keep the money making 10% and borrow the 6%. How does the mortgage fit in your overall financial picture? And that's what we consider. And this is just another product. So
speaking of which, I was hearing from somebody that Trump's trying to do something with your IRA where you can use it for purchase.
For down payment, yeah. That's another thing that we'll be watching. That was also proposed. Yeah.
Mhm.
Yeah. So it's a lot of interesting things coming up that we're going to be watching. So anything else? That's what I had today. We covered a ton of stuff. So anyway, guys, it's always a pleasure. Have a great January. We shall let's see here. We shall see you next month. If you have any other suggestions, I was just checking the chats to see if anybody had anything else. If anybody has any suggestions, let me know, but we'll just keep plugging away. And think of us when you're trying to get a mortgage. My goodness, we've got so much knowledge and so many different products we can really help you. So anyway, thanks, guys. Take
Thank
care.
you.
We'll see you next month.
Thank you, John. Thanks, fellas.
Thanks.
Thanks, John. See you guys.